This is episode 30 of EO Radio Show. Private foundations are required to spend a minimum amount each year for charitable purposes, which is known in the industry as the minimum distribution requirement. A private foundation determines that amount each year by computing its distributable amount, which is equal to the foundation's minimum investment return, with certain adjustments. Many adjustments, in fact. Like all other private foundation rules, there are a lot of exceptions and special rules, and I'm not going to cover all the rules exhaustively in this episode. But listen in for an overview of the rules and a lot of resources for learning more on the topic. Welcome to the EO Radio Show, your nonprofit legal resource, brought to you by the Exempt Organizations Group at Farella, Braun & Martel. My name is Cynthia Rowland, and I'm a partner at Farella. I'm a business and tax lawyer with more than 30 years of experience advising clients on nonprofit and charity law. Through this podcast, our lawyers and guests will discuss a range of legal and business issues impacting the nonprofit world because we understand you work hard every day to make your community a better place to live and do business. Many of our programs focus on the basics, and at times we'll do a deep dive into narrow and complicated legal issues. Again, welcome to the EO Radio Show. We're glad you're here. I'm recording this episode just as we celebrate the beginning of the Year of the Rabbit, and it occurred to me that the organizing principle today should be rabbit holes. The topic today is Internal Revenue Code Section 4942, which sets up the minimum distribution regime for private foundations. There are just pages and pages of Treasury regulations that cover the myriad defined terms that are used in Code Section 4942, and that's not even enough guidance. This is an area of law that has generated a huge number of private letter rulings. For those listeners that aren't tax geeks, and let's be honest, that's probably 99% of you, private letter rulings should be explained a little bit. These are rulings that are issued from the IRS, not a court, and are not generally the product of a dispute between a private foundation and the IRS. Instead, private letter rulings are sought to get agreement in advance between the IRS and the foundation as to a particular issue. These letter rulings don't serve as precedent for anyone other than the particular private foundation that requested it. However, they are extremely useful roadmaps for other foundations and their advisors. Private letter rulings are optional in many circumstances, but actually are required for a foundation that wants to set aside funds for future uses in order to meet the minimum distribution requirement, and are also often sought to get assurance that the IRS agrees that a particular asset is an exempt function asset or that the distribution is a qualifying distribution, among other things. Like the other excise taxes that apply to private foundations, the tax penalties for violating these rules are so steep that it is never a good idea to just ignore the rules. A private foundation that fails to pay out the distributable amount in a timely manner is subject to a 30% excise tax under Section 4942 on the amount of the undistributed income. The tax is charged for each year or partial year that the deficiency remains uncorrected. And then top of that, there's an additional 100% tax that is triggered if the foundation fails to make up the deficient distribution amount within 90 days of receiving a notice from the IRS of its failure to make the minimum distributions. So you can see the tax penalties are so steep that these are not optional rules. These are mandatory. Okay, so let's go back. The big picture context. Here's a reminder for these minimum distribution rules. This is the big idea. Every year, a private foundation determines its distributable amount. The distributable amount then must be distributed as qualifying distributions by the end of the following tax year. A foundation may set aside funds for up to 60 months for certain major projects. Excess qualifying distributions can be carried forward for a period of 5 tax years immediately following the tax year in which the excess was created. So that is the minimum distribution regime in a nutshell. Now, let's start with identifying the rabbit holes we'll go down today. What is meant by the terms distributable amount, minimum investment return, exempt function asset, qualifying distribution, set aside? How are assets valued? Those are our rabbit holes today. All right, starting with distributable amount. The distributable amount is the minimum investment return reduced by certain taxes paid by the private foundation and increased by 3 numbers. Number 1, the repayments of amounts previously treated as qualifying distributions, such as PRIs that are repaid in that year. Number 2, amounts received or accrued from the sale or other disposition of property previously treated as a qualifying distribution. For example, the sale of an exempt function asset, say a building used in the exempt functions is sold in the year. Third, in determining the minimum investment return, we add back amounts previously set aside for charitable purposes if the set-aside was treated as a qualifying distribution but is no longer necessary for the purposes for which the amounts were set aside. And we'll talk about the set-aside rules in more detail in a future episode. Minimum investment return is another rabbit hole to go down. The minimum investment return generally is fixed at 5% of the aggregate fair market value of all of the foundation's assets, net of acquisition debt, other than those assets that are used directly in carrying out the foundation's exempt purposes. A side tunnel of this rabbit hole for minimum investment return is valuation. As you can imagine, a number of factual questions come up when trying to determine fair market value of the assets, and there are a lot of tunnels to explore here. The regulations provide numerous rules for valuing foundation assets. Specific rules apply to valuing publicly traded securities, cash, real estate, and other assets. The group referred to as other assets includes a lot of things, obviously, and these are valued under a general fair market value rule. Other assets include things such as alternative investments, that is, private investment funds such as hedge funds, private equity funds, real estate funds, venture capital funds, commodity funds, offshore fund vehicles, and funds of funds. Certain securities and cash are valued monthly to arrive at an average for the year. Other assets, excluding real estate, which can be valued every 5 years by independent appraisal. Anyway, other assets besides real estate are valued each year. A hot topic here is the valuation of cryptocurrency, which generally is treated by the IRS as property that has to be valued like any other asset. Unlike publicly traded securities, the exchange price for a cryptocurrency is not generally deemed to be fair market value. But I digress. The regulations also describe how to determine the appropriate valuation for assets held less than a year, for a short taxable year, or when the foundation changes its accounting period. So check out the rabbit holes in that part of the Treasury regulations if these circumstances arise for your foundation. Another branch of the minimum investment return tunnel is whether an asset is used or held for use directly in carrying out the foundation's exempt purpose. There are many examples in the regulations, and I'll include a link to the applicable reg in the show notes. There are many examples in those regs that address how to determine which assets are included in the calculation of minimum investment return. Often, it is easy to determine whether an asset is held for the exempt purpose, but there are many private letter rulings that address interesting circumstances. For example, situations where the foundation wants agreement from the IRS that what appears to be an investment asset or an investment use should instead be treated as held for a qualifying use because its immediate use for the exempt purpose isn't practical based on the circumstances in the particular case. Foundations in those circumstances often request a letter ruling and explain to the IRS the definite plans that exist to commence an exempt use within a reasonable period of time. For example, on this topic, the Treasury regulations provide that property acquired by a foundation to be used for its exempt purposes may be considered held for a charitable use, even though the foundation leases the property for a reasonable period, reasonable generally meaning not more than a year, during which arrangements are made to convert the property to its exempt use. So this can be an important exception. But the bottom line here for a basic understanding of the minimum distribution rules is that assets that are held for the production of income or for investment, typically stocks, bonds, loans, private equity investments, or leased real estate, are treated as not used or held for use directly in carrying out the foundation's exempt purposes, even though the income from those assets is used for those purposes. However, an important note here is that investments that meet the technical requirements for a program-related investment, that is a PRI, are excluded from the asset base for determining the minimum distribution amount. On the other hand, mission-related investments, or MRIs, that don't meet the technical PRI requirements generally are included in the asset base, in order to determine the minimum distribution amount. There are also a number of letter rulings that address the timing of the conversion of assets from investment property to property used for exempt purposes, since the effective date of a conversion of an asset like that is important in determining when the value of the converted asset is removed from the minimum distribution calculation. Generally, the converted asset will be excluded as of the time that a plan for conversion is adopted and the implementation of the plan begins. Now, anyway, back to our main tunnel in our exploration of the Section 4942 rabbit hole. What distributions are qualifying distributions for purposes of meeting the minimum requirement? Now that we've determined our minimum distribution amount based on asset values, our next question is, which distributions will qualify as part of our minimum requirement? So, generally speaking, qualifying distributions consist of any amounts, including reasonable and necessary administrative expenses, paid by the private foundation to accomplish its charitable or other exempt purposes. Qualifying distributions also include amounts paid to acquire assets used directly in carrying out these purposes, like buying a building where you'll actually operate the exempt function, or purchasing artwork for a museum, things like that. Generally speaking, qualifying distributions are limited to amounts paid to accomplish one or more of the charitable purposes, but note it also includes amounts paid exclusively for the public purposes of a state, a possession of the U.S., a political subdivision, the United States, or the District of Columbia. Many foundations do make grants to governmental entities, and those can count as a qualifying distribution if made for exclusively public purposes. Qualifying distributions also include certain set-asides and program-related investments. These topics, that is, set-asides and PRIs, are topics that merit their own episodes. So other than noting that they are important concepts for many foundations when determining their minimum distribution amount and qualifying distributions made, we'll take a pass on those rabbit holes today. Watch for a future episode on set-asides and PRIs. It's already in the works. If you haven't already subscribed to the EO radio show on your favorite podcast player, go ahead and subscribe and you'll see these episodes soon. Anyway, back to today's topic. Grants and contributions to other Section 501c3 organizations may also be treated as qualifying distributions, but transfers to controlled organizations are problematic. Grants made to private non-operating foundations or to other 501c3 organizations controlled by the donor of the private foundation or disqualified persons with respect to the grantor foundation may be treated as qualifying distributions only if such distributions meet the flow-through exception in 4942. The flow-through exception applies when the grantee organization promptly distributes the amounts from the grantor foundation to other public charities or uses the grant amount directly for its own exempt purposes within a year. So when considering a grant to another foundation or public charity that is controlled by the grantor foundation, carefully consider the requirements if the grantor foundation wants to consider the distribution as part of its minimum distribution requirement. Also, keep in mind that certain grants made to supporting organizations will not count as qualifying distributions. There are two important scenarios that a grantor foundation needs to be aware of in this circumstance. That is, in the circumstance of a proposed grant to a supporting organization. First, amounts granted to a Type 3 supporting organization cannot be counted as a qualifying distribution unless the Type 3 supporting organization is a functionally related Type 3 supporting org. A functionally related Type 3 supporting organization is defined as one that doesn't make payments to its supported organization, but instead actually carries out activities which perform the functions of that supported organization or carry out its exempt purposes. The IRS intends to issue regulations regarding the definition of a functionally integrated Type 3 supporting organization, but as of the date of recording this episode, these regs on supporting organizations are still on the priority guidance plan at the IRS. So in the meantime, foundations that want to make a grant to a Type 3 supporting organization will need to rely on some interim guidance in a 2006 notice that's linked in the show notes, so you can find it there. The second issue for grantor private foundations that want to make a qualifying distribution to a supported organization relates to certain Type 1 and Type 2 supporting orgs. Amounts granted to a Type 1 or Type 2 supporting org can't be counted as a qualifying distribution if disqualified persons directly or indirectly control either the Type 1 or Type 2 supporting org or one of its supported organizations. This disallowance provision requires an analysis of control at both the supporting and the supported organization level. So that was quite a rabbit hole that hopefully doesn't apply to many listeners, but something to be aware of. To really explore the supporting organization rabbit hole, you may want to listen to episodes 23 and 24 of EO Radio Show. Episode 23 covers the basics, and episode 24 takes a deeper dive into Type 3 supporting organization requirements. A final note before we wrap up today, the Section 4942 taxes on failure to make qualifying distributions do not apply to private operating foundations. Episode 18 of EO Radio Show is the Nonprofit Basics episode that describes the requirements for qualification as an operating foundation. So check out that one if you want to explore that rabbit hole. So that's all for this episode. Be sure to check out the show notes for links for more resources on the minimum distribution rules and the related topics I've mentioned today. I'm Cynthia Rowland, and you've been listening to EO Radio Show, your nonprofit legal resource, brought to you by the Exempt Organizations Group at Farella, Braun, and Martel. If you have suggestions for topics you would like for us to discuss, please email us at eoradioshow@fbm.com. That's eoradioshow@fbm.com. Thank you for joining us, and until next time, make a difference.